about trading here nowadays.
Trading is pretty confusing, but that doesn't mean it cannot be easy. In this video, I want to show you some pretty important. At first glance, trading may seem quite simple. You know, you're buying when it's low and selling when it's high, but apparently that is not how it works. And if it worked like that, then more than 10% of day traders would be long-term profitable. And it only gets more complex when you're deeper and deeper into that topic. So there's gotta be big catch in here, somewhere. From the perspective of a person who starts to delve into it, there's a lot of boring stuff. Starting with choosing a platform, looking for a good source of knowledge from which you'll get information on how to start trading in general, choosing the right broker. It's just you can see that there's a lot of it. And this is only beginning. Because from the moment you start trading, you start learning skills that can only be acquired through trading itself, and without which it is impossible to make money from trading in the long term. It's hard to tell, but I would say that whole process can take something around 2 years, maybe. Despite all this, the title of this video is not "Trading is harder than you think." So where's the easy part? Okay, coming back to the topic, there are basically two main trading platforms, TradingView and MetaTrader. You have to learn both, although the second one looks like the Excel from year 2000. There are a lot of brokers, they offer trading on various financial instruments. You have to choose which one you want to trade on. Generally speaking, you have to get off your ass and read about what they offer and which one will suit you best. Sometimes there are absolute megamites who immediately open a live account, deposit money, and start trading on the spot. You can guess that the money flies out of their account very quickly. Many of them quit trading after such an adventure and will never forget to write on Reddit that only those who are lucky earn the most, and without luck you cannot do anything in life. Which, I mean, you can't, technically you need to have some luck, but you get what I'm saying. Others, however, are not discouraged, and after such a situation, they start thinking about what can be done better and usually start looking for a guide from some pseudo-guru, unfortunately. It is hard to be surprised, since YouTube is literally full of content like how I earn $400 a day with this secret strategy, or live streams where people loop video where some woman pretends to trade.
Even if you can take a closer look a little lower, we can conclude that the strategy is working if we focus on two indicators at once. Don't trust just one indicator.
Well, because of this whole mess, it is easy to step on one of videos from this category. And for a person new to this world, it is very difficult to verify whether a given creator is legit. That's why people often come across some who will recommend his own secret strategy that he has never told anyone about and will help you make a lot of money, of course, but don't let banks find out about it. I don't think I need to explain that after such brainwashing, the story of sinking money often repeats itself. Finding a good source of information is hard, and I can only suggest taking a look at these three guys. From what I saw at first glance, I don't have any gag reflexes watching them, so you can try to get acquainted with their videos. Maybe the strategy of one of these guys will suit you. Just remember that what works for them will not necessarily work for you, so it is worth following advice or elements of the strategy but not copying the whole thing, because there is high probability that even though you watch every video they make, you will still lose money. Okay. You have strategy, you set up a demo account, and then practice. The whole process is about making trades according to whatever assumptions you come up with in your head and testing what works and what doesn't. Thanks to this, you are able to develop experience without which you'll not be able to be profitable in long term. Then, when you gain experience, your win rate will still be probably very low, or at least lower than you expected it to be. The goal of gaining experience is to be able to earn more on trades in relation to the losses incurred, as a result of which, at the end of the day, week, month, year, you are in profit. And there will be periods when you'll have losing streak. I don't know how long it will last, maybe even a month or more. But that's why you need to have experience. After a while, it is easy to distinguish the basic differences between things that work and things that are fraud. For example, it is easier to tell if a guy who's trying to sell you a straightforward strategy with indicators trying to scam you. And after experimenting with various strange and complicated strategies, you come to the conclusion that it doesn't matter at all. Price behavior is so random that it cannot be predicted. It is simply impossible. From this point, the entire approach to trading comes down to simple basic assumptions. And only then it turns out how easy the trading process itself is. Because the goal you need to achieve is not to predict future price movements, but to manage risk and losing trades in such a way that you will just survive. Over time, you start to notice the actual disadvantages of the indicators. I took these two ones, for example, here is MACD and EMA. And for example, here the price was rising, then it fell slightly and seemed to go below this line, then jumped above it and then fell again, only to go up after a while. Here the price rebounded several times and actually reacted to this average, but suddenly it fell below it, which would suggest a further decline, but despite this it suddenly jumped above this average and then fell down after a while. Now look at MACD. Here, for example, it signaled a decline and the price went sideways and went up. Here, if I trusted it, I would earn something. The conclusion is that these indicators will not predict price movement. Sure, an experienced trader can use them as much as he wants, but I have the impression that he would be able to cope without them because they won't show you anything new. It's similar with support and resistance. I will draw some here. In this case, the price rebounded nicely, and after the breakout, it retested and went further. And here, it wasn't so rosy and the price did all sorts of strange things. This is a 4-hour interval and the zone has been tested many times. This is not my or anyone else's fault that drew zone incorrectly. This zone simply did not constitute any guarantee or even a significant increase in the chance of a price rebound. The behavior of the price is simply too random. It's similar with price action. Here, there was a long wick at the top and a lower low was broken, and the price suddenly went up. Also, for someone who sees such a long wick and bearish candle formation, you can see that the price may drop down, but as you can see, nothing could be further from the truth. When you look at the price action, never take it as any kind of prediction. You can, for example, simply feel that the situation looks like the price may go down or up, but only as a suggestion. Price formations are also popular, and the same here. It works in some way, but whether the price will actually continue to trend after continuation formation is also a lottery. For example, here is a parallel channel formation at the moment when the price broke the bottom and came back to retest. Then it rose again to this channel and stayed there for several hours, only to fall later. Such situations can easily confuse traders that it is a fake out or something. Here, the wedge formation. And in this case, the price was preserved and actually continued the trend. So, hear me out. Price formations, like almost everything in trading, sometimes work, but when you're playing only two price patterns, in my opinion, it will be difficult to actually build something from them. The last thing that comes to my mind is messing too much with intervals. When, For example, you use two weighted averages, each interval will tell you something different. If I were to treat the zone between one EMA and another as support or resistance, then the situation clearly looks bearish. In 1 hour or in 4 hour, not completely, because it's holding onto the support. In 1 day, it looks like it could sleep a little longer, but soon it had support. If you go back even further, you'll have something different. And one more tip about low intervals is that they should be avoided because they are very susceptible to sudden movements that destroy the entire price structure, and it is difficult to manage risk in such situations. Finally, video is over. Thanks. Thank you for watching, man. Thanks.